We're right in the middle of this huge shift in the AI market, and it's no longer just about buying anything with AI in the name. Nope, it's about something much deeper, something way more fundamental. Let's break down what's really going on.
This right here, this is the new mantra. The market rebound we saw in December, it gave us a really clear verdict. The AI revolution is absolutely real. But that era of just buying any tech stock you could find, that's officially over. See, this market isn't about just getting AI exposure anymore. It's about AI selection. So here's our game plan. We're going to start with the new rule of the market, then get a serious reality check on AI. After that, we'll look at how the Fed is actually helping things along. And then we'll uncover this huge structural pivot that I think most investors are missing. From there, we'll look at who's winning and who's losing, and finally, lay out a game plan for 2026. All right, let's jump in.
Okay, first up, the new rule of the game. After a period of, let's be honest, some pretty wild speculation, the market is wising up. Capital is getting a whole lot smarter about where it's going.
It's a really simple but profound change. We are moving from pure speculation to careful selection. The market isn't just funding every cool story anymore. It wants to see the money. Capital is now making a clear distinction between a good narrative and actual, tangible cash flow.
And this brings us to a perfect real-world example that shows exactly what this new selectivity looks like. It's a classic tale of two giants in the AI space, but with totally different outcomes.
This has been the question on pretty much every investor's mind, right? After that massive run-up, headlines started popping up, sparking fears that the whole AI bubble was about to burst. But the real story, it's a lot more nuanced than that.
So just look at what happened back in mid-December. First, news breaks that this massive $10 billion AI data center project connected to Oracle got canceled. The stock drops, and those bubble fears just spike. But then, just a day later, Micron Technology comes out with these stunning earnings and nearly doubles its guidance for the next quarter. And why? Because of soaring demand for its high-bandwidth memory chips, the actual hardware that makes AI work. See the difference? This wasn't hype, this was real, physical infrastructure demand. So with that story in mind, let's zoom out a bit. Because the big picture, the macro environment, it's no longer a headwind for the market. Actually, it's turning into a pretty powerful tailwind. A really crucial piece of data dropped in December. November's inflation number came in at just 2.7%. That was way cooler than the 3.1% Wall Street was braced for. And for the market, this was a huge positive surprise.
And that cool inflation number? It really cemented the market's expectation for Fed rate cuts. The market is now pricing in an 80% chance at least half a percentage point in cuts by the end of 2026. This kind of easing policy creates the perfect environment for those long-duration, cash-generating assets to really do well.
And now we get to the core insight of this whole explainer. This is the part that I think most investors are still missing. This isn't just an AI cycle.
It's an AI plus reshoring cycle. I mean, think about it for a second. Data centers need a ton of power. That power needs grids to deliver it. The grids need factories to build the components. And those factories, well, they increasingly need to be built right here, at home. AI demand isn't just some abstract thing happening in the cloud. It is quietly pulling billions of dollars in capital back into the physical, domestic economy.
So here's the crucial point. The capital is flowing down the stack. Sure, it started with the story, the AI app. But the real money, the hard cash, is flowing to the tangible stuff. From the cloud service to the physical data center that's basically a factory, and finally, right down to the engine room, the hardware and memory chips that are generating massive revenue as we speak.
And this huge structural pivot is creating a massive divergence in the market. It's not a rising tide lifts all boats situation anymore. Not at all. Now, selection is everything.
Okay, let's look at some real examples. In the quality growth camp, you've got a company like NVIDIA with real earnings and incredible pricing power. You contrast that with a momentum story like Oracle, which stumbled because the execution just didn't live up to the narrative. Then you look at companies with durable cash flow. Visa's global payment network, it just keeps churning out cash. Now compare that to a company like Nike, which is facing a structural decline in its really important China market. You can see it. Capital's rotating away from global weakness and pure hype, and it's moving towards quality and domestically focused earnings.
So what does all this mean for you, right? How do you actually position your portfolio for this new cycle that's already happening? Let's walk through a potential game plan.
Now, this is just an example framework, but it really reflects the core idea we've been talking about.
A big chunk goes to quality tech, specifically those AI infrastructure players. But, and this is key, you also see a large slice for industrials and energy. Those are the companies building the fabs, the power grids, the supply chains. Then it's balanced out with stable cash generators in financials and payments and some defensive staples. The key to the whole thing is the focus on AI-driven, domestic infrastructure and earnings.
So to wrap it all up, there are really three core principles to keep in mind. First, with inflation cooling down, the Fed is your tailwind, not a headwind. Second, in a market this selective, quality, we're talking strong balance sheets and real cash flow is your best shield. And finally, try to see volatility not as a threat, but as a filter. It's what separates the real winners from the losers.
At the end of the day, the winners of this next cycle won't be the companies with the loudest stories or the most hype. They're going to be the ones quietly turning AI demand into real, domestic earnings. The key is to look right past all the daily noise and focus on where capital, policy, and cash flows are structurally lining up.
If you want to go even deeper on the structural analysis behind these themes, we have our full note available. And for anyone who wants to understand the market quietly, structurally, day by day, you can follow us on X. Thanks for tuning in.